What role do shareholders have in managing agency conflicts between themselves and the managers of the firms they invest in?
So this is a second paper which we executed on the same topic of like the rise of passive and the effects on financial markets, and then this paper really on sort of corporate governance, right? And the agency conflicts between shareholders and managers is pretty much like an evergreen topic in finance, and arguably it's the original principal agent conflict, right?
Mm-hmm.
There are probably thousands of academic studies going back to Mike Jensen, who recently passed away, rest in peace, back to Burl and Means in the early 20th century. And as usual with most classic questions in economics, even Adam Smith wrote about it. I realized we quoted this in our paper, so I wanted to point out. Smith, 1776, the directors of such joint stock companies, being the managers of other people's money rather than of their own, cannot be well expected that they should watch over it with the same anxious vigilance with which the partners in a private co-partnery watch over their own.
Yeah, it's been around for a while.
Yeah.
Okay, so that matters a lot. Shareholders' role in corporate governance. How significant is index fund ownership of individual stocks?
It is significant. So the big three passive fund providers, namely BlackRock, Vanguard, and State Street, between them hold 20 or more % of all the available shares of every single US public corporation, right? And for other countries, other stock markets, the fraction is lower, but they are catching up as money flows in and they continue to try to diversify. And the fraction is continuing to rise everywhere because passive investing continues to rise. The train has left the station.
Mm-hmm.
And I should say that passive investors' influence on corporate governance is even larger than that kind of shocking number would suggest, because owing to their fiduciary duty, these funds show up at every shareholder meeting and they always vote on every item.
Wow.
Other investors generally don't.
Interesting.
That is interesting. I hadn't thought about that. So how are index funds' incentives to monitor their portfolio holdings different from those of traditional actively managed funds?
It's very difficult to say. It's complicated, and it is still an open debate how the incentives of index funds to monitor differ from active funds. Okay, if you ask BlackRock or Vanguard or certain of my academic colleagues, they'll say, look, these are gigantic long-term shareholders, and as a result, they have a very strong incentive to monitor their portfolio firms. On the other hand, if you ask others in the industry, or if you ask other of my academic colleagues, I would point at a beautiful classic paper now, 2017, by Lucian Bebchuk, Alma Cohen, and Scott Hurst. Okay? In that paper, they point out that index funds, because of their fundamental business model, they have very little resources or incentives to monitor their portfolio firms. The bottom line is that the fundamental business model of an index fund is polar opposite from the business model of an active fund. Index funds do not try to generate alpha. Their only job is replicate the index as closely as possible, as cheaply as possible. Moreover, the index fund industry is brutally competitive, right? Index fund investors are shopping now on the basis of like individual basis points per year in fees. It's viciously competitive. And you've seen this race to the bottom where the fees are staggeringly low now. You can park up money in VTI and Vanguard will replicate this giant total market index for you for, 5 basis points a year?
Yeah, it's crazy.
It's incredible. So the Bebchuk et al. Paper, argues on that basis that index funds therefore have neither the resources nor the incentives to monitor their portfolio firms. And that controversy is what we wanted to look into and try to get some answers.
Yeah, it's super interesting to think about, because I have often thought that, what's the difference between large active managers holding most of the assets versus index funds from the perspective of this type of thing. But there is actually a difference because of their fundamental business model. How do you measure monitoring? How do you measure how well index funds or active funds are doing monitoring the companies they own?
So our main measure of monitoring, we look at how funds vote at shareholder meetings on contentious items. Those are items where the firm management and ISS, the third party recommender ISS, Institutional Shareholder Services, made different recommendations on how shareholders should vote. And we see those items as being where the funds really have to show you where their allegiance lies.
I looked up VTI just to be sure. I think the expense ratio is actually 0.03. So it's even lower. It's almost basically, like I said, market beta is basically free at this point, right?
Yeah, it's cheap.
So empirically, how well do index funds monitor relative to active funds?
Index funds are much more management friendly. For example, we find that across the board on these contentious items, when management, for example, when management recommends a yes vote, but ISS, the third party, recommends a no vote, active funds vote yes 44% of the time, while index funds voted yes 53% of the time. That's a 9 percentage point gap, which in this like voting literature in this area is huge.
Man, so we have the agency conflict between the shareholders and the managers, and index funds are more often voting with management compared to active funds.
That's right. And you'll notice, by the way, that the active funds come in at 44%. So you're talking about a world 20 years ago where on average on contentious votes, management did not get what they wanted. As we move more and more and more toward passive, recall passive voted management's way 53% of the time. You're potentially tipping into a world where on average on these contentious items, management gets what they want.
Yeah. Okay, so we talked about the low cost of index funds being potentially part of the overall incentive issue here. How do the expense ratios of index funds affect their quality of monitoring?
So we find that index funds with higher expense ratios, the voting gap actually shrinks. That is to say, they are relatively less management friendly, and they vote a little bit more like active funds would. And I should say this finding is consistent with another classic, fairly recent paper by Jonathan and Katerina Llewellyn. And that paper argues that index funds do in fact have some incentive to monitor based on their fees. So you don't get bonused if you run an index fund on the basis of like generating alpha. That's not your job. But if, Mark, you run VTI and you have some intervention you could do that would be accretive to firm value, right? First of all, they point out your fiduciary duty would require you to do that intervention. Second of all, they point out if you can raise one of your portfolio firm's values, your AUM goes up and you collect extra fees on that. And also investors may notice that your returns are looking a little better. And as a result, you may attract more AUM through that indirect channel. And the fees do provide you with an incentive. And our finding is sort of consistent with that story.
Wow. I mean, intuitively, that seems to make sense, right? But wow. Okay, so how do we know that index funds aren't engaging with management beforehand and then voting in support of the proposals that they've pre-negotiated?
Yeah, this is a really good question. So there are three main pillars, we think. Well, three pillars as to how shareholders can monitor and make themselves heard. Okay, this is like corporate finance 101. We divide it into voting, exit, and engagement. Okay, so we said on voting, there's this really, really sizable gap that we observe. On exit, you almost don't even have to check, but we did go and check just to be sure. And yeah, it turns out that active funds turn over their positions enormously more than index funds do.
Right.
So therefore, the threat or the possibility of exit is enormously weaker for index funds. Okay, so that leaves just the possibility that they're making it all up on the side of engagement, right? That they're engaging way more behind the scenes. Now, engagement is very hard to measure. I do have a couple of projects in the hopper that I won't tip my hand yet, but we're working on that. But on this project, we do have one window on engagement because if a mutual fund owns more than 5% of a particular firm, it's a block holder, and it has to file one of two forms with the SEC in order to disclose that fact. So Form 13D is the form that the fund will file if it has the intent to, there's some legal language, but it's something like the intent to engage with or alter the conduct of the firm. And then there's also Form 13G, which is considerably less, the reporting requirements are less onerous, but it requires that the fund has no such intent. So we went and we looked, we scraped the SEC, website, and we did a bunch of data analysis. And what it turns out, interestingly, it's pretty simple to state, index funds always file the second form, 13G. In fact, we could not find a single event in our sample ever in which an index fund filed the activist form 13D, where they stated that they intended to engage or alter the firm's conduct.
Man, that's crazy. Yeah, so it's like it's the voting index funds are doing worse, but there's this possibility where they're doing engagement behind the scenes, and they're always voting with management because they've convinced management to do what they want beforehand through engagement, but they're never filing the form that would suggest that they're actually doing any engagement.
Correct.
Wow.
And you'd say, well, okay, but those 5%, you want to be a little skeptical, of course. So you say, well, those 5% block holder, that's maybe a minority of observations. You're not seeing everything. Well, yes, but those 5% block holder holdings are precisely where you would expect them to engage the most. Right? Because they have the most ownership and the most at stake, and they don't.
Yeah, that's wild. So how does index fund ownership affect other firm level governance issues?
So we find no effect at all on measures of entrenchment, such as poison pills or staggered boards, things of that nature. On the other hand, those entrenchment measures, dual class share status, another classic measure of entrenchment. On the other hand, if you think about dual class share status or poison pills, those are very slow moving. You generally need like a super majority vote just to change that, right? And so you might well expect that you wouldn't, they'd be very slow to react. On the other hand, we do find pretty clear effects on managerial compensation. A bump to your index fund holdings and a reduction in your active holdings is followed by lower pay performance sensitivity and higher total compensation for the firm's top managers. And that seems like pretty clearly worse for firm governance.
So then what's your main conclusion on how index funds affect monitoring and corporate governance?
So let's kind of recap. So index funds, we find, vote in a way that is significantly more management friendly. They're less prone to exit or engage with their portfolio firms. And increased index fund holdings are followed by lower pay performance sensitivity and higher compensation for top managers. And overall, it paints a picture that the rise of index funds may be leading to kind of worse oversight and less monitoring.
Which is like bad. Like that's at some point that's destroying value for shareholders, right? That's the problem.
Yeah, I mean, it's not just that. It's also, it's not, so you're absolutely right, Ben, that it's going to eventually be value destroying. But even more than that, you can point to Briccardo, Zingalis, and Hart, for example, and other folks who have been pointing out the rise of kind of the desire for socially responsible conduct, socially responsible investing, and socially responsible conduct by the firm, so-called stakeholder capitalism. Right? And worse governance and less monitoring and oversight by your shareholders is worse for all stakeholders.
And you've got a paper on, I think, related to that topic too, that we're going to get to in a second. But okay, so we've talked about how index funds are not really affecting price efficiency because there's this equilibrium, and that's all fine. So that's great. But they're also deteriorating corporate governance, which is not so great. So what are your just like general thoughts on, are index funds good, or is there a problem here?
So for the shareholders, so for the investors who are able now to park their money in VTI and get maximum diversification for, as Mark pointed out, 3 basis points a year, this is unquestionably just a gigantic boon, right? And hats off to Jack Bogle, Vanguard, and all the folks working in the passive fund industry. They've done a great thing. What are the potential down the road unintended consequences of this? That's the real question of this whole line of my research. So we think of financial capital more broadly in the sense of like everything on the right hand of the firm's balance sheet is funding for the firm one way or the other, and that's financial capital. And we generally taxonomize it according to 2 dimensions, right? Cash flows and control rights. Bonds have very, very defined cash flows and relatively weak control rights, except if you're in default. Stocks have much hazier cash flows, but stronger control rights, this kind of thing, right? Now, my dear friend and brilliant co-author Matt Ringenberg once put it really nicely. I think we were out, drinking bourbon at some place downtown in Salt Lake City, and which is where we get all our best ideas. And Matt said, he said the market for cash flows is really, really competitive and efficient, and the market for control rights really is not. And I think that's a great little aperçu that stuck with me, So on the financial side, there are lots and lots of really strong incentives and money at stake and mechanisms that push us back towards efficient liquid functioning, right? On the governance side, if you think about the market for corporate votes or the market for corporate control, much less so. And so that's the reason why I suspect that with the continued rise of passive, we will probably still continue to see financial markets functioning well. In fact, if you just look in the very broad patterns over time, financial markets, liquidity, and most measures of efficiency have just been getting better over time,
right?
Over the last 2 decades or so. If there are consequences, unintended consequences to this rise of passive, I think we're going to see it on the side of corporate governance, the side of control rights.